Hello. Hi, everyone. Good afternoon. My name is Danny Salman, Senior Market Analyst from MultiBank Group. In case you guys didn't know, we've been established since 2005, USA, California. And since inception, we've managed to increase our global presence with over 25 offices worldwide. We have over 280,000 clients and retail traders working with us across 90 different countries. And we pride ourselves by being one of the few and globally trusted and regulated financial derivatives companies worldwide. Now, I'll be talking today about some key market trends moving forward into 2021 and sharing with you all some investment ideas and opportunities. 2020 has continued to surprise us. A year of pandemics, economic shutdowns, a global equity market collapse, one of the deepest recessions since the 1930s, and now recent all-time highs in the U.S. equity market. So we're going to take a closer look at the U.S. market outlook, and I'm going to use the GDP, which is a primary indicator to track overall economic health. As you can see in the minus Q1, we see a contraction rate of 5%, following a contraction rate of 31.4%, primarily due to the pandemic in the US and the shutdowns, and a sharp reversal in Q3. Now, it's important to note that we are still in the recovery phase of COVID-19, and we might not possibly see the vaccine in full effect until later next year, so mid-2021 to end of 2021. Which brings me to my next point. COVID-19 has actually accelerated secular trends. And when I say secular trends, I speak about trends that are neither seasonal nor cyclical. They maintain a solid trajectory regardless of economic uncertainty. And so that's why I'll be presenting my point on investment strategy and point on high quality stocks and their performance during different GDP environments. Now, if you want to quantify high quality stocks, you quantify them by profitability, returning surplus cash flow to their shareholders, a proven track record of cash flow generation and positive ROE, stability, and of course, the flexibility to adapt in different market environments. So let's take a closer look at the chart. So as you can see, when GDP growth rates were above 2.5%, the S&P Quality Index roughly performed nearly the same as the S&P 500 benchmark index. A minimal difference. However, when we look at GDP growth rates below 2.5%, we see that there was a significant outperformance of nearly double an annualized return. And it's very essential to note that the yearly forecast for 2020, US GDP forecast for 2020, is predicted by analyst estimates and the IMF to be at a contraction rate of minus 3.5%, and possibly even moving forward into Q1 to Q2. So as you can see, the quality index outperforms the S&P 500 benchmark index when GDP environment growth rate is low. Now let's take a closer look at quality companies versus mid to lower quality companies. As you can see, high quality companies have a lower annualized volatility. Now what does that mean? That means that they're less riskier than other companies or stocks. And what does that create for investors and traders? It creates an attractive risk-return profile by two factors. One of which is that you have an outperformance during low growth environments, And two, it's less riskier and less volatile. So let's take a closer look at the constituents of the quality index, or the high quality stocks. So we have the likes of Apple, Microsoft, Nvidia, Procter & Gamble, Johnson & Johnson, Cisco, Adobe, Merck, and Nike. And all tradable on our platform. And if we want to look at a quick sector breakdown, the majority being in 40% in information technology and 22% in healthcare. Now, with all the potential returns investors and traders can make during low growth environments, it's also important to note that every investor and trader should always have protection on the downside. And that's why I move to my next theme. We speak about gold. And gold has always been, as you may all know, to serve as a safe haven asset during economic uncertainty. And gold, now, however, gold hasn't outperformed all traditional asset classes during different periods. However, it has maintained a competitive return profile in comparison to other traditional assets. The likes of commodities, such as crude oil, natural gas, and silver, has outperformed them all on a 10-year, 20-year, 30-year performance range, and including emerging markets on a 10-year and 20-year performance range. And one extra thing I would like to mention is that the annualized return from 1971 to 2019 for gold has been 7.65%. So clearly debunking any misconception that gold is a risky investment or trade. So now we look at gold's performance during different interest rate environments, and we see that gold during a negative interest rate environment averaged a 1.2% average monthly return, and during a moderate interest rate environment between 0 to 2.5%, gold averaged a 1% monthly average return. Now we take a look at the forecast for 2021. These are my forecasts as well, moving forward. And based on other analyst estimates, we see gold trading around 2,200 to 2,400 range by mid or end 2021. And so just to recap, what are the fundamental drivers moving gold? As I mentioned before in the previous slide, low interest rate environment. The Federal Reserve will keep interest rates between 0 and 0.25% in the years to come. A weakening US dollar due to quantitative easing and monetary stimulus, and also to be proposed eventually, potentially, and target inflation rates set to increase in the years to come. Now we take a look at gold from a technical analysis standpoint. As you can see, gold in the highlighted blue section, gold has a strong negative correlation against the S&P 500 benchmark index at negative 0.6, clearly showing its hedging purposes and its qualities. And the outperformance of the S&P 500 by roughly 7%. I've also showed you all the fib retracement. I took the data points to be the yearly high and low, and we can see a solid bounce off the 50% fib retracement level, which indicates it to be a strong support. And another important indicator is the moving average, the 200-day moving average. It did not significantly break it, so reinforcing the bullish sentiment and fundamental variables driving gold as a trade and investment moving forward. And so, one of my next topic I'll also be talking about is some of the advancements and adoptions of technological trends happening in our day and age. And with the likes of cryptocurrency, we have seen an accelerated adoption rate of cryptos. And we have seen that with some fintech companies two fintech companies, which I largely attribute the recent surge in prices behind the recent surge in prices. So you have Square buying $50 million worth of Bitcoin, nearly 1% added onto their balance sheet in early October, and following that, PayPal allowing users to buy Bitcoin. So it's important to note that we have started to see some accelerated trends towards cryptocurrencies and making a more accepting means of transaction between people. And so I've also included an interesting chart for you all. It's actually a survey, which I found interesting. So it's a survey conducted among people across the globe in different countries, and we see a younger demographic or age group that are willing, that have transacted or bought and sold cryptocurrencies such as Bitcoin. And we take a closer look at the questions asked during the survey, also again reinforcing the positive insight of younger people towards cryptocurrencies, and whereas older generations weren't quite accepting of the cryptocurrency. And so now it's important to look at people's perspectives, but it's also important to know where institutional money is going. And that's where you identify longer term trends. So I've also had this chart. We've seen a rapid increase in the adoption of institutional investors with Bitcoin. I've added this chart for you all. This is a chart from Grayscale. In case you guys did not know, Grayscale is one of the largest crypto asset manager companies worldwide. And as you can see, the inflow in 2019 has been greater than that of 2013 to 2018 combined. And another important thing I would like to add is that 71% of that inflow came from institutional investors. So now because there's always been a persistent question as to where are the institutional investors when it comes to crypto. So now we have somewhat of some empirical data that this is part of a longer term and more sustainable trend towards the future. It's also essential to know that we've moved away from the gold currency to the fiat currency. And now, with the recent trends and adoption rates, we could possibly see a new trend emerge moving forward into the future. And so, just to recap my presentation, 1, outperformance of high-quality stocks during low-growth environments. 2, investing in trading in gold, serving as a hedge. And 3, accelerated adoption rates of cryptocurrency, which may be part of a longer-term trend. Thank you all.